Welcome, ladies and gentlemen, to Collier Bristow's US-UK podcast, a series which opens the umbrella of guidance to shield the unwitting US-UK taxpayer from the rain. If you're a regular listener to the podcast, please do leave a rating or a review on whatever platform you're listening on, as it really helps us expand our audience. Today, we're going to consider a topic that's been requested a few times, and that's the topic of the everyday American and what they can or should be doing in the international tax and estate planning world. While professional advisors like to talk in broad strokes about individuals with never-ending levels of wealth, we shouldn't forget that particularly with Americans, they are in need of a certain level of planning by virtue of being an American subject to worldwide taxation. And who knows, every American surely dreams of being the American with never-ending wealth. Isn't that the American dream? Now, to discuss that, I'm joined today by Laurence Leigh, a UK-US investment manager at Canaccord Genuity Wealth Management. I've checked Laurence's bio in advance on his firm's website, and I'm led to believe, Laurence, that you sit on Canaccord's UK Small Cap Stock Selection Committee, which sounds incredibly exciting. How are you? And is that committee as exciting as it sounds?
Hi, Aidan. Good to be with you. I'm well, thank you. It is at the moment. I think small caps and volatile markets are a very interesting topic, let's say.
Yes, I think probably the last 18 months in particular, not sort of, referencing any worldwide events, but I imagine the last couple of years has been a particularly unique experience.
For sure. I think from COVID until now, and I think it's probably going to continue in the foreseeable future, that there is a lot of interesting small caps out there, and it's an interesting space to be in, particularly at the moment.
So for all you people looking to make your small cap selections, you now have a committee member you can go and speak to. So in this two-part episode, we're going to look at tax, estate planning, and investment management for Americans who, listening to this series thus far, have thought, well, this is all well and good, but does this all really actually apply to me? Or rather, how do I get into all this stuff? Or what do I really need to know? All well and good having your head up in the clouds in your ivory tower, but what are the things I actually need to be able to take away and understand? And that's why we're here today to talk to you guys. The place, Laurence, I really want to start is possibly something that you've spent plenty of time talking to clients with in generic terms in your career, which is why are Americans people that we pay particular attention to? I don't know whether you have a thought on this from an investment management perspective, but I always draw this back to the point I actually made at the top of this episode, which is taxation by citizenship. So the old aphorism is that there's only two countries in the world that tax by citizenship, which are the USA and Eritrea. I'm yet to meet a client from Eritrea, for what it's worth. And the USA, being a country that taxes by citizenship, puts it, like I said, in that fairly unique position versus what most countries do, which is tax on some form of territoriality. You are in the UK, you're taxed in the UK. If you're not in the UK, you're not taxed in the UK in general terms. And I presume that from a kind of investment management perspective, ultimately, it's that same global reach that causes an American to need to be more mindful of their sort of wealth management, even though they may have lingering connections to the US these days beyond their citizenship. Am I sort of in the right ballpark, you think?
I think that's exactly right. I think that's where the complexities and the issues come down to, that Americans are taxed on their citizenship on a worldwide basis. And because of that, there are consequences to the type of investments Americans can hold, and also complexities when it comes to reporting those investments from a tax point of view. And this, as I'm sure a lot of our audience may have experienced before, this has led a lot of UK wealth managers to turn away US clients due to these complexities. What we do at Canaccord, when we specialize in looking after Americans living in the UK, is our first starting point is to say, we're not going to forfeit a good or sound investment strategy just to simply achieve a client's tax and compliance objectives. Investment for us is the first and foremost, and then we look to find the US-friendly solutions to meet our clients' objectives. And we've always had the view that even though it's a complicated area, with some specialist knowledge, there are tax-efficient UK portfolios out there that we run that look very similar or sometimes exactly the same to how a purely UK or US client would invest. I'll give an example at this point. We have an asset allocation framework at Canaccord. Basically, in a nutshell, we have certain allocations to different asset classes depending on our client's level of risk. That is exactly the same whether they're a UK client or a US-UK client. It's the same exposure, just a different way of getting that exposure.
That's really useful to know. Thank you. I mean, we will certainly come on to the client who is now starting to accrue their wealth such that that's something that they need to think about. Indeed, that's the whole reason, Laurence, why I want to speak to you today. It's probably worth reflecting that even before we get to that stage, there are probably by number the majority of Americans who live and work in the UK for whom their contact with the US from a tax and reporting perspective largely falls onto two planes. One is that they are a salaried employee. And so broadly, as far as the IRS is concerned, the individual needs to think carefully about where they're paying tax. Are they paying tax in the US where they're just a salaried employee in the UK on PAYE and they've got to report that somehow to the US? And possibly when they come to sell a home or a property in the future, because that is going to be a time when a lot of people make a capital gain. It's just that capital gain may not be covered by a complete main exemption relief in the US like it is in the UK. Beyond those two examples, US tax exposure is probably not something that most Americans think about on a day-to-day basis. In fact, probably most Americans don't think about tax on a day-to-day basis, full stop, because they're not weird like me. But how to deal with it is very complex once you start to move into a more diverse, multifaceted portfolio or wealth profile. And that, Laurence, is where we come to with the sorts of work that you do with clients. And I should say, we're not going to get into on this episode questions about what happens if I want to give up my citizenship, because that is an easy out, an off-ramp, shall we say, from the discussion. I'll just stop being an American. There is an episode, if keen listeners recall, that I did with Nixon Peabody, the East Coast US law firm, when we talked about some of the consequences of expatriation. And I've also talked several times about how it's something that I did myself a couple of years ago. We're going to assume throughout this process that the American we're dealing with is going to remain an American. So let's say, Laurence, that the person that we're dealing with is someone who has spent 10 years, 15 years, 20 years, whatever it is. They've been slowly accumulating wealth, and they've gotten to a stage in their life where they're no longer thinking about all of the money they're making going out on their expenses, but they're starting to accrue wealth, and they're starting to think about their planning on a long-term basis. Maybe they are thinking about saving for the future, for children, for grandchildren, or for their retirement, but there is an amount of money on the side that they're now having to start thinking about what to do with. Where do you start when you're speaking to individuals about this turning point, this inflection point in their sort of financial history and the sorts of things they need to start thinking about?
Yeah, of course. For us, the first thing is always our clients' objectives and their goals. And this isn't just for Americans, this is for all our clients. When they come to us with a sum of money, the first thing we are going to be asking them and thinking about with them is what are they looking to achieve with that money? Because at the end of the day, everybody has different objectives and priorities. And because of that, they have different goals. Everyone also has different tolerance of risks. People have certain investment restrictions. Some people may have a requirement for income, and some people may look towards more growth-orientated portfolios. And timescale is also very important here. What do the next few years look like for the clients? Are they looking at short-term priorities like school fees, or more long-term requirements such as retirement? That for us is the main objective and the main discussion we start to think when we speak to a client, specifically looking at the US side. As I said a bit earlier, the goals are the most important. And then from then on, we decide the best strategy to achieve those goals, not the other way around, which is very important for us. We're not going to be telling a client, this is what you can do, choose one of these options. It's all about client tells us what they want, and then we can find their strategy that's US friendly. And there are a lot of ways to do this. The fact finders are very popular, and experience has shown us a very good way of being able to build the client's portfolio and looking at the client's objectives. Because when we do a fact find, we can ask questions that the client may not have thought about before. They start to think about things that they hadn't thought about. A great example of Americans is, are you planning on educating your children, whether born or unborn, in the UK? If the answer to that is yes, it means they're going to be in the UK for a significant period of time. And then, for example, from that, we can start thinking about, okay, so you've come to the UK, you've got a X amount of dollars in cash, for example. You need to start diversifying those dollars, because if you're in the UK full time and you have dollars and sterling goes up, for example, you can be losing value from your assets for doing absolutely nothing. actually looking this year when we've seen sterling up 5-6% versus the dollar, it's a very good example of that. So that's where we would start. And then from them, we can look at other things like, is there potentially one side of the couple that may be a UK client, purely UK? And then we can think of things that are advantageous to UK clients that may not suit US clients as much, such as ISAs, which we'll talk about as well in more detail.
You might have gathered on this episode, and people more clearly on this series, I like a good metaphor. You're really interested at the beginning on the end destination. There's bugger all point in plotting which route if you're an American you're going to take to get there if you don't know where you're going. So as you say, are you investing for your children's long-term education, and is that going to be in the US or the UK? What's the sort of time horizon on that? How you get there might be, you want to be invested in these sorts of industries, or perhaps more specifically, you don't want to be invested in these sorts of industries. You're a particularly ESG conscious person, for example, or perhaps on the flip side, and it's what I always like to joke about with wealth managers, maybe you're really, really keen on the most sinful of stocks, and you think, yes, I'll be invested in all of the munitions and oil and tobacco that I can get my hands on. I don't think I've seen an anti-ESG portfolio that someone can invest in quite yet. But am I right that that's why you're looking for the end destination? Because you can't really advise what the best way of getting there is until you know where there is, if that makes sense.
Yeah, that's exactly right. If a client comes to us and they say, let's say they're 40 years old, they've sold their business, they've got sufficient income to sustain their lifestyle, they're not looking to retire for a great number of years, they've got a pension they can't access for 30 odd years, we are not going to be invested in low risk income stocks for that type of client. That type of client is suited to more capital appreciation to grow his asset base over that period of time, rather than produce income from a portfolio because he has income already. And that's where wealth management really comes into its own. It's about meeting clients' individual objectives with a certain type of portfolio. And that comes down to asset class, but it also comes down to looking at certain sectors. For example, an elderly client nearing retirement probably wants a less volatile portfolio in companies that are less volatile than, for example, high growth tech companies, which a younger investor may find more attractive because they've got more time on their side. So for sure, that's definitely correct.
And that bit you mentioned at the end about asset allocation versus things like age and the level of risk involved is probably something that people may not realize. That is something that goes on sort of by default automatically in most people's occupational pensions that they have. So I'm in my early 30s. That pension I have is going to be, I think, if memory serves, vastly by sort of value, by proportion, invested in equities, because I'm someone who is going to be invested in my pension for long enough that I can ride out any kind of short-term blips in the stock market. But I believe it's the case that as you tend towards retirement, the pension provider will start to divest you of your equities and start to move you into maybe bonds, and then move you from bonds out of cash, so that you've kind of got a safer landing into your retirement, sort of reducing the risk. Now, of course, reducing the reward as well, because you get, I'm sure you tell me, Laurence, less of a return on your investment if it's in cash than if it's in equities. But that is something that goes on already sort of automatically with even your everyday person. It's just that we're looking to replicate that or more actively plan on that basis with broader funds.
Yeah, that's exactly right. So we have clients that come to us and their portfolios 10 years later may look very different. We've increased our allocation to things like fixed income and alternative investments, which don't correlate to the stock market because they're getting older. They don't want as much volatility. They may require some income in retirement. So, of course, the portfolios vary across a wide range of ages, and allocations to asset class is a very good way of giving clients their return in line with the risk that they're willing to take. And at Canaccord, for example, we have different risk profiles, and the lower the number, the higher the allocation to things like alternatives and fixed income is, to reduce that volatility and to produce that income the client may be looking towards retirement.
I want to take us back to something you mentioned previously, which is ISAs. ISAs are a common discussion topic when we're dealing with Americans, comparative to non-Americans for whom ISAs are a very, very common account product that people want to turn to. And I want to sort of broaden out the picture slightly to think about a topic which I think I did once refer to before in this series, but I can't remember the episode I did it on, of sort of the champagne tower, where the client who has started to have surplus income every year, there is an unfortunate position where they are starting to generate, maybe small sums, maybe large sums, but, let's say they're starting with the smaller sums. And they're thinking, where should this money be going? Again, I think you'll tell me, Laurence, this is not something unique to an American in terms of how we strategize where that money should go. But even to me as a lay person inside your world, I know I can put my money in an ISA. I can keep my money in a generic bank account. It might be a bank account that has a fixed rate of interest, or it locks my money away for a certain period of time. I can put my money into my pension. I can open an account with Vanguard, or I can open an account with someone else, and I can start trying to trade by myself. We'll come on to that a bit later. Even an American, I've also got my IRA, for example. How do you start to have that discussion with people about, and maybe this built into your long-term versus short-term horizon strategy planning, how do you have that discussion with clients about where their money should be going so that it works best for them?
First thing to say is that I didn't think we'd be talking about champagne towels on this podcast, because you never know what to expect. That's a very important point, because wealth management isn't just purely about investments. It's also about tax efficiency. And from a broader point, there are a lot of tax efficient investment structures in the UK. Pensions and ISAs are two of the most popular ones. And yes, that is correct. And as I said earlier, the great thing about a pension, you put money into a pension, you can get it matched by your employer, it grows capital and income tax free. People that open pensions can't access them till, over 55. They're able to, if they're of a relatively young age, they're able to put their more higher risk investments within a pension, because automatically they have that long-term time horizon. And it's a very tax efficient way of growing their wealth. Looking at ISAs, they also grow income and capital gains tax free. But we tend to, if you have an ISA and a pension, you want one allocation to be slightly lower risk, we tend to say the ISA can be slightly lower risk, because in the ISA, because there's no income tax, you can have your high dividend stocks in an ISA, which tend to be a bit less volatile. Your Diageos, your Unilevers, the companies that are really pumping out cash for shareholders, they can be held within an ISA. On ISAs are very popular top things to have in the UK, and they should be. They're fantastic things to have. You can put £20,000 in per year, and everything grows in their income and capital gains tax free. There's also clever things you can do at the end of the tax year to make sure you're taking your gains for the year and also taking any losses to offset them going forward. A lot of Americans come to us with ISAs, and this comes on to why getting advice in this field is so key. Because an American living in the UK, they've lived here for a long period of time. Their friends, their bank manager, I don't know, someone told them, get an ISA, it's fantastic. Or get a JISA, a junior ISA, which is for children. It's a fantastic way to save for your child, for example, potentially for university. ISAs are not recognized investment vehicles in the US, which is very important to know. So we say to our US clients, you can have an ISA, but make sure everything you're buying in that ISA is compliant from a US and a UK standpoint, because you will have to do a tax return on that ISA in the US. And we have, unfortunately, seen circumstances where Americans assume an ISA is a tax shelter in the UK, and they buy assets they're not allowed. And then when they do their tax return in the US, you can get caught out. And then just a final thing to say on ISAs, this is where these conversations, this fact find is very important. I would say over half our clients, husband and wife clients, one side of the spouse is British and has no US connection. And a very good idea is to open an ISA in the British person's name, because then you can have a portion of that client or that couple's wealth growing tax-free. So you've got the American side, which is all compliant from a PSEC HMRC reporting status. But then you've got the British side, where they have an ISA and all their assets, maybe their income or growth assets, are grown in that ISA, and that's tax-free, because obviously they're not doing a US tax return, they're British, but they don't need to declare that in the UK because it's a tax-free wrapper.
We like to refer to those couples as mixed marriages in our in our line of work.
Yeah.
I think the point that you and colleagues like you have mentioned before is that it's almost safer to assume that if I'm an American and I'm looking at what's ostensibly a UK product, a UK wrapper, a UK account that garners some kind of tax relief in the UK, that it's almost safer to assume you won't get that tax relief in the US and proceed cautiously than assuming it's a thing that works in the UK, therefore surely it might work in the US. The US and the UK have a double tax treaty between the two countries, which do say in certain circumstances that one country will reciprocate the planning for another country. Pensions is a common example between sort of 401ks in the US and sort of pensions in the UK. But I've certainly forewarned clients many of times about this, and I've certainly heard people, Laurence, like you, talk about this many times. You know, you've got ISAs in the UK on the one hand, and in the US, you look at things like 529 plans and UTMAs and UGMAs and IRAs that are just not viewed in quite the same way because the UK does not have a reciprocal arrangement for that product. They may do one day. So it's always been my cautious approach to say to people, you should assume this is not going to work. And as we'll come on to when we think in the second half about possibly some estate planning, it generally tends to be the rule that if you're looking for the best and most simple and tax efficient planning and the easiest life, simpler usually is better. Maybe not from a investment management perspective, but certainly from a tax exposure perspective, simple is usually best. I think that probably brings an end to the first half of this two-part episode on investment management, tax and estate planning for the everyday American. We are going to come back, Laurence and I, in the future, and we are going to look at the second half of our discussion, looking at some more planning ideas for Americans living in the UK, and then extending the discussion to think about their estate planning as well. Laurence, thank you so much for joining me this time. Ladies and gentlemen listening, thank you so much for joining me, and we will both see you next time. Thank you very much.